All right, good morning, everybody. So, got a little bit of a mixed bag. The market trying to adjust a little bit to the idea that uh, tariffs are being used as the stick to beat companies into line or countries into line and get them to bow down to America's wishes. Everybody is screaming about inflation, cost to consumers. So the market's rally kind of stalled a little bit. It's picking back up again, kind of fits and starts really. And, that makes sense. We don't want to see things in the indexes moving with the same parabolic speed that we've seen some companies moving lately. Europe down about 0.25%. Small caps right behind that at 0.25. Then the Dow, S&P up 0.25, and the NASDAQ with Hong Kong at 0.5%. So it's a bit of a curve. We are going to get FOMC minutes today, just the minutes. I know that there's always somebody who asks me, if this is FOMC. It's not, it's just the minutes, right? We already had the FOMC meeting. This is their neatly organized, detailed, which is laughable, but I'll use that word, detailed meeting notes and minutes. So while these do generate some movement in the market, it's not the same thing. There won't be a pal presser and questions and all of that stuff, right? Don't confuse the two. They're just two completely different things. We do have additional auctions today, the 52-week and the 5-year note. Always pay particular attention to these auctions. It doesn't cost you anything to watch the clock. So watch the clock. All right, we talked about this point of control from a few weeks back and how it was likely a line in the sand that we would have to fight through. And now we've set a really nice tweezer top there. Now that we've cut through it, the base case estimate is that there's no more liquidity there, but that needs to be proven. So as we come back into that zone, we want to watch to see if there's still something to fight. Otherwise, liquidity resides on the other side of the pivot, and we have a new pivot. We have the tweezer that I just referenced. We did get the gap closed, which is good. That's healthy. It's exactly what you would want to see. And we've made a higher high after making this lower high, right? So after breaking this structure, higher high, higher high, higher high. Then we had this lower high, and we've just barely broke above it. Barely does count. But we need to see if this is going to build out what they call a complex topping pattern or if it's going to continue the run. It's just a candle concept, right? The way that we define and read topping patterns. So now that we've broken this high, we need to go up and at least get an equal high, if not a higher high, way up here. If we get back down under this, it's not exactly putting us into a bearish posture yet. We would have to come all the way down and break below that low to get into a bearish posture. That's a long ways off. We're talking, underneath 59.80. So 40 plus points at least. And we'd have to go that far just to get the designation of bearishness, right? And that doesn't mean you'd have to wait that long to enter or anything like that. We're not talking about confirmation triggers or anything. Just in technical analysis, are we in a bearish posture? No, we wouldn't be unless we broke that low at 59.80. So a little bit of concern for sure, especially if we can't hold this pivot that we just broke through and broke out of if we come back in again. This is a central pivot range. It's basically a floor pivot with a mathematically calculated channel on each side of it. And this channel grows on a day-to-day basis, wide, narrow, and we look at that channel for clues and indications of what kind of trading day should or could we expect. If we break out, what's the expectations that this breakout's going to grow legs and we really run, versus if we break out that it just fails and we come back in again. When the channel's really wide, the expectation is breakouts are going to fail and we'll just come right back in. When the channel's really narrow, we have the understanding that breakouts can really grow legs and we just do it, just run. While this isn't the most narrow channel, it can get so narrow that you don't even see the yellow lines at all. You just see the purple line. That's how narrow it could be. But if you look, it's 2 ticks wide. 2 ticks on each side, right? Which means it's basically 1 point wide from top to bottom. That's a pretty narrow channel. Now, these channels don't make price do anything. Just because it's narrow, it doesn't mean we're going to break out. It just implies that if we do break out, it could really grow legs and just continue the drive, continue that push. Well, how far? Since it is a pivot point, we can lay out the S&R levels. The channel that I've been talking about is the daily floor pivot. Underneath this, we've got the weekly floor pivot. Generally speaking, if we're above the weekly floor pivot, we're in a bullish bias. We also had an MDP yesterday. That's a missed daily pivot. We didn't hit that pivot. And it doesn't count for yesterday. It counts for today. And that's because at any point yesterday, it could have hit the pivot. So it doesn't count as an MDP until today. If you want to know more about those MDPs, it's not my strategy. It's not even a typical floor trader's system. It's something completely different. Just hit YouTube and type in missed daily pivots. The guy who really popular with this concept, he's got some good videos on YouTube. It is a trader's strategy, but you don't have to trade the strategy. You can just use it for analysis and for understanding, right? I don't trade missed daily pivots, but I certainly recognize their impact and I watch for them to understand what price could do. So being in a bullish bias because we're above the weekly pivot, with today's pivot opening above the previous day's pivot, completely outside of the channel, and with price opening above today's pivot, all of those are bullish check marks. If we break out of yesterday's high, it's very likely that we're going to expand considerably. Hey, desk hog, give me some room. My cat wants to take up all the space. But to even get to yesterday's high, one step at a time, we got things that we have to work through. So we want to focus on that. Just breaking through our own Globex high that we had back here with that evening star reversal and a nice dump. We've made it back up. We got the breakout. So far, it's sticking. Then we've got to get through the RTH open of yesterday, and then the high of yesterday, and then through the liquidity zone up there. Now, there's a trade that I really like, and it's called yesterday's 111. I need a better name for it, but it's what the trade is. It's focusing on yesterday's 111. Liquidity resides on the other side of the pivot. So if 100 is the pivot, liquidity is between 100 and 111. A lot of times we get that breakout, we get into the 111 and we're not able to get through it and we dump back down again. Even if we do manage to rally, you get like a first touch play where the first time we get to 111, it fails. And then we run back up and try again and we make it through. That liquidity can be all the way up to 123. So it can be all of that. Once we get through that, however, then we're focused on the next leg up, 50% measured move, 100% measured move. We'd be focused on just working our way up from there. All right, we got the anchored VWAP on the week that started on Sunday. And then we have today's VWAP. We're above both of those. So neither one of those are really going to be in our way. They're not an issue. And then, of course, the monthly VWAP, we're way past that. No issues. The volume's a little light this morning at 94, but it's better than it was yesterday at 67. And it's really the opposite direction of what we had expected. Remember, I said yesterday, we kind of expect this to fade a little lower on the week as the week gets closer to the holiday. And yet that's not what we're seeing here at all. That's almost 50% more volume than we had yesterday at this time. Now, last week we were seeing, volume in the hundreds. So it's not extreme. It's just more than we had. They're not sitting out. They are engaged and participating. And they're not hedging. So you can see we're at the call wall. Generally speaking, that's where we would expect a lot of liquidity. It's where we would expect resistance, I guess is a good word for it. We just have a hard time getting through it. But don't believe that it's set in stone and that we can't just continue to drive through it and above it. In fact, if we overshoot it, and there's no set level here to kind of explain this, but at some point when you get through it too far, it'll just be like a self-fulfilling loop that the farther we drive above it, the farther we'll go above it. And we'll just keep going and going until we run out of time at the end of the day. It's like a short squeeze. But of course, you can't have that in the futures, right? But it's the same kind of logic. We do have the ADR up here at 60.47. If we can get through that, there's a voodoo line up there, an options level, and then the full ADR. So that's what this kind of greenish color is. And then the options level here in red, and then the full ADR. So it won't be a smooth, straight shot all the way up, right? We'd have to fight it level by level by level. Now, forget for a moment that there's anything on the top of this chart, because it doesn't matter what's up there. I could put anything up there. X steel, I mean, it doesn't matter, right? Anything up there. What we want to look at is what's down here. So that is the NASDAQ Cumulative Volume Index, CVI. Thinkorswim has a CVI indicator. Trading Views is better, honestly, but we'll just use this one we're here. When this thing is pointed up, you have more net buying than you do net selling in the entire NASDAQ, right? Not one name or group or industry, just the NASDAQ. And it isn't the NASDAQ 100, it's the NASDAQ composite. On Thinkorswim, we can choose the NYSE, Amex, or NASDAQ. If you look at that on TradingView, you can tell it to look at all markets, all US markets anyways. And it'd give you more insight. But what I'm pointing at here is, one, a little bit of divergence. If you think about where the S&P or the NASDAQ is, this thing is breaking out and doing the thing, right? Next, it's pointed straight up like a rocket ship. It's not sideways, chopping about, giving topping patterns, anything like that. So here's the ES on the right, on the daily. And you can see how price isn't even back into the highs, let alone above and into new highs. While this CVI has already broke through that high and is continuing to the upside. There's still a lot of buying in the market. That's the takeaway, right? That's the surprise, you know, as if everything else that we were looking at so far hasn't given you that indication. There's still a lot of buying going on. Now, we were looking at the weekly, so here's the daily. Same thing. This is bullish divergence. Got the NASDAQ over here underneath that high, and we got this broke out and up into new highs. It's above the Bollinger Bands, although it's trying to come back in, and it's above all of the major moving averages. It's still very bullish out there. Don't fight this flow. It's just going to run you over. How long will it last? I mean, if we all know at some point we're going to get some digestion, and a lot of these big names that's been running, they're going to pull back. But it could run all the way into the new year first before we get that sort of pullback. So either go with the flow or get the heck out of the way. No reason to get run over. $10-day, 30-minute volume profile. Now that we're back up into this zone, as we lose candles here on the left, we're actually reprinting them here on the right. So it's possible that we could see this point of control drop down into this zone if we lose enough of it back here. But the expectation is that it'll come right back up again within a day or two, as long as we don't fall out of this zone that we've created and fall back down in that 59.20 area. We don't expect this to be resistance at this point. It's more of a range. We'll just chop around it and it'll act a bit like a magnet. If we do expand beyond the range that's already been defined, and then we come back to it, it's likely that it will act as a support or resistance at that point. All right, the VPOC was hit from yesterday. It's not what stopped price down here. It's just confluence. We hit multiple things that happened to be one of them, and we turned around there. Still, we're done with that line now. If we had a new VPOC from yesterday, then we could just move the line up into that new spot, but we don't have one, so we're done with it. TPO looks a little extreme there compared to the volume profile. A bit of a discrepancy here and there. More shallow on each of those, and yet way more steep at the point of control. It's something to keep your eye on. We're definitely loading up here at the highs. Think of this as a ceiling. Wouldn't be surprised to see this point of control move up if we stay in this wedge pattern for even just a little bit longer. It's a flat top wedge, so be careful. $60.65 is the week's upper edge. $59.16 is the week's lower edge. So far, we're just sitting inside of yesterday, just baking time. One thing we didn't really talk about yesterday is this width, right? So this is last week's range. Generally, what we do is we take that range and we set it on the new week, and we kind of examine, hey, what's the volatility look like this week compared to last week? Well, there's two ingredients that make up this range. One is volatility, the other is time. So, on a week-to-week basis, if you have a 5-day week and then you have another 5-day week, then your time is the same. The only thing that changed is volatility. That's all well and good until you come across a week that's a 4-day week. Now you've got to adjust for less days and whether or not the volatility is higher or lower. So the range is a little smaller this week compared to what it was last week, but we have one less day this week, right? It's a 4-day week. So it's possible that the more narrow range is because there's just not as many days. If you think about, well, how far could price move on a week-to-week basis? You're asking how far could price move in 5 days? Well, how far can price move in 4 days? Generally speaking, the ADR gives us that kind of answer. It's the average daily range. And right now, the average daily range is around 1.1%, 68 points higher and or 68 points lower. All right, Bitcoin down another 3%. It's still up 2.5% over a 5-day period, but we are seeing more bleeding. And retail, I was looking at retail's short interest, this XRT, its short interest is over 200%. That was a little eye-opening. I didn't realize it had gotten so negative, but yeah, that's wild. XRT is still up more than 7.25, even being down more than 0.5% this morning. Semiconductors are up. SMH and the group Nat Gas up again, now up more than 6.5% over 5 days. China ADRs through the KWeb group, they're up this morning. And the rest of these, like the Mag 7, biotech, healthcare, they're not up enough. They're up some, but we're looking for 0.5% at least. And they just don't meet that qualification yet. Certainly something we can keep our eye on, see if it picks up later in the morning. We have the opportunity for a uh, a bear flag failure, or a bear pennant in this case, on crude. Worth looking at today too. Hot stocks also down. Banks are down, at least KBE. We don't have KRE yet this morning, I think. Not yet. Well, okay, they're down a little bit too. Guess we don't need to see tail risk. Huh. Typo. So this is XRT. See that breakout. Gotta kind of tie into that, the short squeeze, right? Because 200%. I mean, that's got to tickle. Yeah. Look at yesterday after that high set around midday, and the crossover just bled. So if we're looking for that rising tide, kind of scenario that we had yesterday, we're certainly not seeing it today. We're seeing the tide fade and taking everything with it. The things that are up, like semiconductors and things like that, we're back to the same crowded trade where everybody's piling into silver and gold. We got crude up a little bit, kind of goes towards that bear flag in crude. Nice Busby on that bear flag, by the way. China group. And then these others that really need to pick up the ball. SMH, the Qs, gold miners, even energy, healthcare. They're just not up enough. So they got to get some work done. All right, 10% of the S&P is up 0.5% or more, and 16% of the NASDAQ is up 0.5% or more. With the holidays and everything, I think it's safe to say I won't be here Friday. Not 100% sure, but I'll let you guys know by tomorrow. There might not be a morning briefing on Friday. Got my 20-year anniversary, which we didn't get to celebrate last weekend, that we're probably going to do Friday, Saturday into Sunday, kind of make it a whole weekend and kind of wrap it all up. So I'll let you guys know if there is going to be a morning briefing on Friday or not. 20 years, right? It's a biggie. So that's what I got for you guys. Be careful, be safe. Watch for this correlation in market breadth. You know, if we can't get everybody on board, then we're just going to continue to chop around sideways. I'll see y'all tomorrow.